Okay, the time is 12 o'clock and a very good afternoon for everyone tuning in to our Corporate Connect session. So let's let my team get ready for this. Okay, we are good to go. So good afternoon, everyone. Welcome to join this afternoon Corporate Connect session. And I'm Sunny So, your host for today. This afternoon, we welcome First REIT as well as our audience from Moomoo Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with the market highlight segment by Mr. Isaac Lim, my good friend, who is a chief market strategist at Moomoo Singapore, followed by a corporate presentation by Mr. Victor Tan, Executive Director and CEO of First REIT, and thereafter we will dive into the Q&A segment. First REIT is Singapore's first healthcare REIT, listed in 2006. It's managed by First REIT Management and a joint venture between OUE Limited and OUE Healthcare Limited. As of December 2023, First REIT owns 32 properties across Asia, valued at dollar 1.14 billion, and these include hospitals, nursing homes, and integrated healthcare facilities in Indonesia, Singapore, and Japan. First REIT is focused on its 2.0 growth strategy, aiming to increase the proportion of its portfolio in developed markets to over 50% by 2027. Before we dive deeper into First REIT, let me pass the time to Mr. Isaac Lim to share with us the latest market highlights. Over to you, Isaac.
Hey, hi, just testing. Okay, hi, Sunny. Thanks so much for that very kind introduction, right? And thank you, SIAS, for having me on board this Corporate Connect. Really excited to be able to share just a little bit of what I see in the markets. Okay, so let's get right into it. Very quickly, I will share with you guys, our audience here, just a quick update on the US and the Singapore stock markets, right? Really just focusing on these two. Why US, why Singapore? Really because of the interest rate story, and this also being a joint webinar with our friend Victor from First REIT, right? So the interest rate story in the US will definitely also impact, as our listeners will already know, will also impact the REIT markets over here in Singapore. And then after a quick summary of the US and Singapore stock markets, right, I will do a little bit more of a deeper dive into the REIT sector outlook over here in Singapore, how I think the REITs sector will actually perform. If there is time, you guys can feel free to send your questions my way. But I think more interestingly, you guys will definitely want to hear from the man himself, Mr. Victor Tan from First REIT. So let's get right into it. I'm not going to take up too much of your time. All right, so we start out with the US markets, right? If you guys have been following the US markets, it's really a very interesting time to be in the markets, watching the markets, right? The US S&P, the benchmark index, actually reversed from the 5930 resistance, all-time highs, and has also fallen by about 3% since the 5930 all-time high. Now, of course, market is a bit quiet the last 2 days. Really, this is because a lot of the participants are watching in anticipation of the US elections that will be happening, the counting that will be happening later tonight. You know, just before the webinar, I was just having a small chat with Sunny, and he says he's going to stay up. I told him that the last time I tried staying up, I actually fell asleep, right? But yeah, the near-term support to watch on the S&P is actually 5720. Now, what are the markets saying? You know, by all barometers, if you look at the S&P, the run up, and then of course now the cautious reversal, it's not a meltdown, right? It's just for me, the way I look at it is really more people just taking their chips off the table to take a more wait and see approach, because this is historically one of the closest elections ever, right? The race between Trump and Harris has been really, really too close to call. So markets are favoring a Trump win, while famous historian actually says that his 13 key points, the key factors that he watches out for, are pointing to a Kamala Harris win. So this is Lichman, right? His US historian. Why I quote him is because he actually has quite a good track record. He has predicted 9 out of 10 of the previous presidential election winners, right? And he bases it on this 13 different keys here, 13 different factors and reasoning, right? And according to his grading, okay, Donald Trump so far only takes 3 factors, right? The fact that, the White House the White House party gained House seats during midterm elections. That was during the last time when we saw Donald Trump as president, right? The sitting president is running for a re-election, right? So so you can see that Donald Trump, they consider him the sitting president really because now Biden is out of the race. He has handed it over to Harris, right? And then of course you can see that Donald Trump, despite what you do not like about him, you cannot argue against the fact that he is charismatic, right? So he doesn't have to be good charismatic. He can be bad charismatic. Whatever he says tends to get people all riled up and agitated or really, really excited. Depends on how you feel towards him. Lichman, however, didn't give the last two factors, 12 and 13, really because both, whether it was the Republican Party or Democrats, right, both times during the past Trump presidency and even now during the Biden presidency, right, their foreign policies has really taken quite a huge step back, right? So I think this is the sentiment that everybody shares on the ground. This is also the sense that the global political scene is feeling. So just based on all these 13 factors, right, Donald Trump gets 3, Kamala Harris gets 8. Right, even if you were to give this 12 and 13 over to Donald Trump in favor of Donald Trump, if you think his foreign policy is really, really good, right, he still gets a score of 5 against 8. So this is why Lichman actually believes, that Donald Trump is not going to win this election. But the markets are saying otherwise. Right, so if you can look at, if you follow on, right, what will also be happening this week alongside the US election, right, which I personally think it's more important than the US elections, right, is that the FOMC will start to hold its 2 days meeting, right, with the interest rate decision coming out on early Friday morning, right? So this Friday morning, Singapore time, late night, Thursday, US timing. Okay, and I think this interest rate decision will have longer term ramifications for the markets as compared to the short term volatility that investors tend to see surrounding the US presidential elections, right? And if you were to look at this, I took it from the CME Fed Watch website, right? Right now, that 98% of market participants are expecting a 25% cut, right? So 25 basis points cut as compared to 2%, which is expecting a 50 basis point cut. So nothing too out of the ordinary. Okay, I think the consensus is very clear that in light of the US elections, in light of the non-farm payroll that came out last week, right, this 25 basis points is sort of the peacemaking deal, right? Because the last time when the US Federal Reserve actually cut by 50 basis points, Jerome Powell came out to say that, we are still seeing another 2 more rate cuts towards the end of the year. So this is him keeping his promise, right? At the same time, not giving too big a rate cut, given the labor scenario in the US, right? So it's really sort of just balancing everything out across the board, not to inject further volatility than we are already seeing in the markets. Okay, and this here, my friends, is a chart of the the US S&P, right? It's a daily chart. I just want to share with you guys these are the levels, that I would like to share with the audience to watch out for. Okay, near-term resistance will be around the 58.37, 58.40 level. Why? Because, we are seeing a bit of a toppish pattern, like I mentioned earlier. market actually reversed below the 59.30 and is dropping lower, right? But the near-term support at 57.20 is preventing price from actually dropping any lower, right? So you can see the last two daily candles pretty quiet since last Friday, right? So market's really waiting in anticipation. I do think that, you know, even if whether it's a Kamala Harris win or Donald Trump win, I personally think that the S&P is going to do a bounce at least to the 58.37, 58.40 resistance level first. But of course, you know, if it's going to be things like a split decision, which is also possible, right? We might see the S&P actually break all the way through this near-term support, 57.20, and drop further down to the 5600 level, which is the next key psychological support to be watching at. So for the audience, 57.20 is really the strong support that you want to, the near-term strong support that you want to watch out for on the US S&P market. All right, momentum wise, okay, momentum, we are starting to see a bit more of a drop in momentum, but there's not too much of a concern because, you know, as I've repeatedly said, right, participants are just taking their chips off the table to take a more wait and see approach as to who is going to be winning this election. And also on Friday, we have the FOMC interest rate decision coming up. We move over to the Singapore markets, right? STI, unlike the S&P, STI has actually been trading sideways and is holding below the 36.53 resistance. Why, you ask me? I'm so precise, giving a 36.53, right? Because if I were to give you a 36.50 level, you know, sometimes price may spike higher. I just want to give the analysis a bit more room to breathe, right? And the way I look at it, for the STI, you know, further consolidation can be expected between the 36.53 resistance and, of course, the psychological support at 3500. So if you look at the Singapore markets, right, month on month, Singapore banks has actually been doing well from last month to date. Right, DBS is up by 2.5%. I think OCBC, UOB, they are both up by around 1.5 and 1.1% respectively. So banks, the financial sector, by all means, has been doing well. Unfortunately, right, the REIT sector has been seeing further weakness. And, you know, I at a recent Moomoo summit or even just speaking to family and friends over the short break that I took, right? People have been asking me, why are we seeing, you know, the REITs why are the REITs actually showing further weakness with the US cutting interest rates? Shouldn't that actually be good for the REITs, right? Yes, you know, as with all things from a theoretical point of view, they work out well theoretically, but in real life, right, it doesn't always reflect theory, right? The reason is because if you were to look at a 10-year yield, which I will show you guys later, right, despite the rate cuts, despite the 50 basis point cuts, okay, from the US Federal Reserve, right, the 10-year yield, the long-term interest rate, right, of the US government bond has actually been climbing higher. Right, so it's sort of like, you know, you when you're clipping your nails, you can clip the top off, right? But eventually it continues growing, right? So it's a bit of a conundrum that the US Federal Reserve is seeing, right? Despite such a big rate cut, okay, the labor is still pretty much robust, okay. Inflation is still sticky, right? And we are seeing interest rates, consumer spending is also doing quite well, right? We are seeing interest rate climb higher. So I just really want to say, in all this, since now we are seeing further weakness, I still personally think it is quite a good time to pick up and load up on REIT counters, given the cross-asset correlation with US 10-year yields. All right, so I'll show you guys the chart. I think you guys will be able to better understand with pictures, right? Picture paint 1,000 words. So instead of me rambling on, I think it'll be more exciting to look at the charts. So what I have here is the STI, right? This is the STI on the daily time frame. And as I mentioned, you can actually see that the STI reversed below the 36.53, right? I gave it a bit more of a specific level. We are consolidating in quite a wide range here between 36.53 and 3500 support. This 3500 psychological support level is quite a strong support level. Reason being is the graphical overlap that we last saw in July this year. And it's also in line with the 89-day moving average, right? So the long-term moving average right here. So if anything, the STI, the way I look at it, let me just try to see whether I can bring out a pen tool and just annotate a bit, right? I do think we might see the STI. Okay, it's the color. That's right. Yeah, I do think we might see the STI come down to retest this 3500 and then possibly make a bounce, right? So definitely more consolidation within this zone. In the event that we do break the 3500 level, then I see that there is no line of resistance, right? We might see the STI drop a lot deeper to 3350. Going to be quite a painful drop if the STI does that, but personally, I don't think we are going to see this drop. All right, so that's for the STI. And with that, right, I just want to leave this here for a while as we move over to, the S-REIT sector outlook. And I hope I will be able to paint a clearer picture for all of you. All right, so what I have here is the IHS REIT index, okay? And this is the weekly chart, not to be confused with all the previous charts where I actually show the, what do you call that? The daily chart, right? What I do like about this weekly chart, right, is the fact that you can actually give me a moment. Okay, yeah, you can actually see that the S-REIT, right, has actually sort of bottomed out since September last year, right? And more clearly, we actually shaped a sort of a double bottom sometime in May, June, right, this year, right? And what I also like is the fact that we have broken out of this long-term descending trend line support that started all the way back in April 2022. Right, so for those of you, my friends, who have been holding on to REITs, right, especially since 2022, right, it's definitely been quite a tough journey, right? But I'm sure you guys have kept the faith, right? Seeing this breakout here makes me a bit more positive, right? And this recent weakness, this near-term weakness, as I mentioned, that is really because of the US 10-year yields continue to go higher, right? Inflation being sticky despite the Fed rate cut, right? And it's also coupled with profit taking from those people who are holding on to the REITs, right? The run up this period was in anticipation of the 50 basis points by the US Federal Reserve. Right, so now that we have broken out, what I really want to see is for the S-REIT to actually come closer to this 1040 level here. And as long as it's consolidating in this area here, as I mentioned earlier, I do think it's actually quite a good place to pick up some good REIT names and then play it all the way back up to the 1155 level. Right, so this 1040 is also a very nice graphical overlap support level. As you can see, right, we are actually flirting around the long-term moving average. Okay, so every time we come close to the long-term moving average, right, price tends to flirt around it a bit, right? But of course, when it's below, okay, it continues going lower. All right, you can see that it continues going lower. Okay, every time it flirts around this long-term moving average, it goes lower. And now that we are above this moving average, right, as history doesn't repeat itself, if it often rhymes, as mentioned by a wise guy, I do expect to see a bit more flirting around of the long-term moving average here before pushing higher. All right, so that is the general overview of the Singapore S-REIT sector, right? But I want to paint you guys a clearer picture, right? And why I think that there is going to be why I personally am leaning towards the bullish bias for the S-REIT side of things is because, allow me to go over to the next slide. Right, this is the US 10-year yield, okay, and it's on the weekly chart. Previously, I showed you guys the IHS REIT index on the weekly chart. Cross-asset correlation-wise, I'm showing you guys also the 10-year yield on the weekly chart. Now, if you look at the 10-year yield on the weekly chart, right, this period over here was really where the US Federal Reserve there were talks that the Federal Reserve will start to cut rates, right? And then there was a 50 basis point cut somewhere over here. So we actually saw the markets actually pricing in a rate cut, priced in a more certain rate cut, and then finally when the actual rate cut came, right, the US 10-year yield dropped by a bit, right, to the 361% level, and then after that we bounce. But despite the bounce, you can actually see very clearly if you were to draw a line connecting the tops, right, the peaks. Every time it comes back up, okay, I did a measurement, right, it would be at least a 24% drop in terms of the yield, right? 23. This was 23.9, but I rounded it to 24% drop, right? So from the top to the bottom, right? So as I just mentioned, history doesn't repeat itself. If it often rhymes, right? Now that we come to the top around the 442% for the US 10-year yield, right? I expect to see the yield actually start to drop down to the first support at around 394. And breaking below 394, we might come down to the 361 level. And this drop over here is about a 20% drop. So giving time, taking into consideration market time and space, right? I do think that this 20% drop, right, all the way into the end of the year for the US 10-year yield would actually be quite a good indicator of how the S-REIT market will actually recover. And, even though the long-term moving average, this is the 55 exponential, the moving average for the weekly, right? Even though the US 10-year yield has been holding very nicely above the 55 weekly moving average, okay, you can see that we have already broken it once here, and then now we've whipsawed around it back up again, right? So the usefulness of this 55 weeks exponential moving average is not as useful as it was, say, when we were back here or even back here. All right, so don't blindly just use your moving averages indicators. For those of you who look at technical pictures, all right, don't blindly use the indicators. I think my friend Sunny will agree with that, right? Use it, but also understand the rationale behind using it. I want to point out another indicator, which is the stochastics, right? I have labeled it using the purple arrows here. Looking at the past three times that the stochastics actually peaked, right? You can actually see that, the US 10-year yield actually pulled back as well, right? And where we are now, stochastics, we are actually coming close to this resistance, right? The extreme of the stochastics. So around the 442, 4.5% level, that is where I see the confluence of the technicals lining up very nicely. That is also why I think that when the 10-year yield starts coming down, that's when the REITs will actually start to pick up pace from there. Very quickly, because I really don't want to still eat into Victor's time, right? This is just a very quick snapshot of the cross-assets correlation, the negative correlation between S-REIT, the REIT sector, and the US 10-year yield. I've also taken into account the COVID period, so you can see the difference, right? But generally speaking, the REIT is the purple line, and then the 10-year yield is the black line. When the yields are falling, okay, you tend to see the value of REITs appreciate. Okay, we discount the 2020 COVID crisis, right? Because both actually dropped drastically at the same time. And then the recovery, right? The recovery following the crisis was also a bit of a strange period, right? But in the middle of 2021, okay, market has sort of normalized. The correlation has actually sort of normalized back into a negative correlation. So in this period, it was positive. The recovery from COVID crisis was positive. And then in the middle of 2021, it has normalized back to the negative, right? So the value of REITs actually started dropping, right? And then the 10-year yields continue to climb. Right, and you can see that while the yield is relatively choppy following in 2023, right, but the negative correlation generally still remains. Okay, when the 10-year yield was dropping, REITs was actually appreciating, right? And then when the yields were climbing, right, the REITs were depreciating. Okay, and where we are now, you can see that the yield is climbing, the REITs are actually dropping. And as mentioned, there's this trend line that I drew earlier. If the yield starts dropping, we can expect the REITs to start climbing as well. So a very simple snapshot of cross assets correlation, and just taking also more data from SGX, right? SGX does has a very nice broad sector outlook for the REITs. So this is the S-REITs and property trust is the average distribution yields by subsegments. I think our friends from First REIT falls under this healthcare area, which is 4.5. So, just looking at a chart like that, you may think that, 4.5 is not a lot compared to all the other subsegments. Yes, that may be true, but I think we have to be a bit more forward-looking, right? In terms, if you have to look at the holdings of First REITs, I think a lot of it's forward-looking to do with healthcare and nursing homes. You know that our society is aging, both in across the globe, actually. Right. So looking at things from a longer term perspective, I think this will start climbing higher in terms of importance as well. All right. And finally, one more slide will be the total returns of the individual REITs and the trust, right? You can see our friends here, First REIT, right? What I do like is, in terms of the 3-year annualized total returns, you can see it's outsized performance at 13.6%, with the past 1-year returns at about 34.5%. So do take note that this data is as of 30th September from the SGX website. All right, and with that, okay, that is the very quick snapshot of where the US markets are and where I think it's going to go, where the Singapore markets are, where I think it's going to go, further consolidation, and why I think now is also a good time to, just start loading up on more REITs, because the recent weakness has made them a bit cheaper as well. And with that, I would like to leave, the time back to my friend Sunny. Sunny, you can take it from here. Thanks, everyone.
Okay, thanks Isaac for the latest market updates that you have. I agree with you on most of the points, a lot of consensus over there. And in the past few weeks, the pullbacks in the REIT sector was due to a stronger economic data from US, and thereby the expectations that the rate cuts is not going to be as fast as what was earlier anticipated. Hence, a bit of a pullback in the last week on the REITs. But with the elections coming up and some of the geopolitical crisis coming up, REITs could be a defensive sector that you can look at if you don't want to get involved in the volatility of the market. And without delaying more time, I will now invite Victor from First REIT to give us the latest updates from First REIT as well. Victor, over to you.
Sure. Thanks so much, Sunny. Thanks for your kind introduction. And also thanks, Isaac, for your very insightful market update, as well as your very bullish view about the REIT sector, as a whole. Yeah. Okay. Good afternoon, everyone. Thanks for joining us at this SIAS Corporate Connect event. We're also grateful for SIAS for inviting us to be able to participate in this event. Okay, what I'll do is I'll just take some time, to introduce First REIT, as well as to share about First REIT, and then after that we can actually go into a time of question and answer. Next slide. Yeah, okay. Okay, First REIT is actually the first healthcare REIT to be listed in Singapore Stock Exchange. Okay, that was actually done way back in December 2006. Okay, our asset under management currently is about 1.14 billion. This is actually as at 31st of December 2023. Okay, and our vision since day one has been that we want to be Asia Premier Healthcare Trust, and we endeavor to deliver a very stable and sustainable distribution to our unit holder. Okay, and since 2018, we have 2 sponsors. Okay, and one of them is actually OUE, and then the other is OUE Healthcare. Okay, and They are both listed in Singapore Stock Exchange as well, and I think you'll probably be familiar with them. Of course, OUE is actually in the real estate development business, whereas OUE Healthcare is actually operating healthcare asset. And this actually allow us to be able to entrench into their network as well as their affiliation in the Asia Pacific region, so that we can pursue new avenue of growth and collaboration with them in the future. And together, our sponsor, both of them, and also the manager owns about 45% of First REIT units. And of course, the true sponsor also owns 100% of the manager, and thereby reflecting a strong alignment of interest with the unit holders. Okay. Okay, a quick look at our portfolio. We started with 4 property in Indonesia. That was way back in December 2006. And over the years, we have actually grown to about 32 assets, across 3 countries, Indonesia, Japan, and Singapore. Over in Indonesia, we actually have 15 assets there. 14 of them are hospital, and then we actually have 1 hotel and country club. And then since 2022, we have actually ventured into Japan. Currently, we own about 14 nursing homes in Japan, which make up about 23% of our asset under management. And then over in Singapore side, we have 3 nursing homes. They make up about 3% of our asset under management. So Indonesia still forms the bulk of our asset under management, about 75% of it. Okay, next slide. Okay, I'll share a little bit about our master lease structure. Okay, this is actually the master lease structure that is post the restructuring of our leases, that was done in 2021. Okay, so since 2021, we actually have this master lease. Okay, over at Indonesia side, you see that we have a rent escalation, which is actually in the local currency, and this is actually based on the higher of the base rent, which is going up at about 4.5% annually, or performance-based rent, which is measured by 8% of the hospital gross operating revenue in the preceding year. So we compare these 2 numbers, whichever give us the higher number, that will be the rental income for the particular property in Indonesia. Okay, and then for the Indonesia portfolio, we call it the triple net. Okay, what I mean by triple net is that the tenant or the operator take care of the daily upkeep of the property, and they also bear the insurance cost as well as the property tax. Okay, and over in Singapore, our rental leases is actually base rent, and then every year it will go up by 2% increase. And over in Singapore, we have 3 nursing homes. 2 of them are enjoying triple net, which is similar to the Indonesia property. That means the tenant will bear the daily upkeep of the nursing home. They will pay for the insurance as well as paying for the property tax for the particular asset. There's only 1 property that is on double net. What I mean by double net is that for the particular nursing home, we actually help them to bear the property tax. Okay, and in Japan, we have fixed rental, but the rental can be revised upward upon negotiation for every 2 to 3 years for 12 of the nursing home. And then for the other 2 nursing homes, we can actually negotiate for higher rental on every 5 years. Okay, and out of the 14 nursing homes that we have in Japan, only 1 nursing home is on the triple net lease arrangement, whereas the other 13 of them we have to bear the insurance cost as well as the property tax, where the daily upkeep of the nursing home is still under the obligation of the tenant. Okay. A quick look at our weighted average lease profile. As you can see, that our weighted lease profile are pretty long. This is partly because of the nature of our asset, which are mainly hospital or nursing home. Okay, so we actually have a very long WALE of about 10.8 years. Okay, and if you look at our asset, more than 4/5 of our portfolio has a lease expiry of over 5 years. Okay, those that are within 5 year, only a handful of the property. And of course, the one that's coming up for renewal, next month is actually the one of our non-core asset, hotel and country club, which we have been putting this particular asset on divestment. And notwithstanding that this particular asset is on divestment or is in the market, we've actually put in place the short-term lease, and we will be extending this lease for this particular asset to December 2025. And then there is a 4.5% escalation on the renter as well. Okay, and then we will continue to focus on divesting this hotel and country club, and we will actually make the necessary announcement as and when there's any material development to this project. If you look at our tenant profile or tenant base, we have also diversified post the restructuring of our master lease agreement in 2021. In the past, we only have a couple of tenants, maybe 2 or 3 tenants, but over this restructuring, we have actually now we have more than 10 tenants. We have actually 11 tenants. Okay, but if you look at the tenant mix, 80% of our rental income still come from Indonesia. Okay, but out of this 80%, half of them actually come from Siloam Hospital group, which Siloam is actually performing quite well. So they shouldn't have any problem paying the rental to us. And in the long term, we're also optimistic that rental contribution from Siloam will increase from the current 58% in terms of the number coming from just Indonesia alone, to about 80%, okay, in the long run. In fact, 81.3% in the long term. That's where all the 14 Indonesia hospitals started to enjoy the performance-based rent, which is based on 8% of the gross operating revenue of the hospital. Okay, and also in the spirit of transparency, as announced in our recent business update, rental outstanding from one of our Indonesia tenant, PT MPU, amounted to about 7.9 million. That was actually as at 30th of September 2024. While their security deposit with us is only about 2.3 million, but we also have another tenant, another party to this tripartite arrangement, which is actually Siloam. Okay, so Siloam also has given us the rental deposit of about 4.3 million. Okay, so the total rental outstanding after the rental deposit from Siloam and also from PT MPU is only amounted to about 1.3 million. Okay, and there's no rental outstanding from Siloam. And we will continue to engage PT and PU with regards to this rental in the real. Yeah, maybe later I'll share a bit more light about our engagement with them. So besides this rental outstanding, there's no other rental outstanding from the other tenant. Okay, over the next few slides, I will touch on our summary of our key financial, and this is actually the summary of our financial performance in Sing dollars term. As you can see, rental and other income, as well as net property and other income, has actually fallen by about 5.3% and 6% respectively year on year. This was largely due to the depreciation of the Japanese yen as well as Indonesian rupiah against the Sing dollar. And consequently, the distributable amount also has declined by 3.4% from 38.4 million to 37 million. So for 9 months 2024, the DPU is actually 1.78 Singapore cent, and this was 4.3% lower than 9 months 2023 DPU of 1.86 cent. Okay, additionally, we we actually give out quarterly dividends. So for this 3Q 2024 DPU, we'll be giving out 0.58 cent. This is 3.3% lower as compared to the two preceding quarter of 0.6 Singapore cent. Okay, but if you look at the underlying, the underlying performance of our asset in Indonesia and also in Japan, particularly Indonesia, they continue to perform well. So in the local currency term, the Indonesia asset has actually grown by 4.4%. Okay, whereas the Japan nursing home is very stable, and then of course at the Singapore side, the rental increase is about 2%. This is in line with the this agreement. Next slide. Okay, quick look at our balance sheet. Our balance sheet continued to be very healthy. Total asset was marginally lower. This was actually mainly due to the depreciation of the foreign currency in Japanese yen and also in Indonesia rupiah. Total liability has increased slightly. This is due to an increase in borrowing, mainly due to the drawdown of loan to fund the working capital. And then if you look at our total issue unit, has gone up by 0.8%. This is actually due to the fact that we have issued new units for payment of the manager fees to the manager. Okay, the portion of our fees that's paid to the manager is actually in the form of units. Okay, so on the per unit basis, our book value or the net asset value has dipped slightly to about 29.16 cents now. Okay, next I will touch on our debt maturity profile. We will continue to strengthen our capital structure so that we can remain resilient. So as at 30th of September this year, the proportion of debt on fixed rate or hedge basis is actually about 86%. And this is actually one of the highest among the S-REIT. And also we do not have any refinancing requirement until May 2026. Okay, and our cost of all-in cost of debt remain very same at about 5%. Interest cover ratio is also very healthy at about 3.9 times. Gearing has creeped up slightly to about 39.3%, and our total debt has also increased slightly to about 462 million now. Okay, so we will continue to maintain our quarterly distribution. So as you can see, this quarter, we'll be giving out slightly lower distribution of 0.58 cent. This is actually largely also because of the currency depreciation, notwithstanding the fact that we also have entered into some currency hedge to mitigate the drop of this currency. Okay, but we believe that healthcare, real estate remain a very robust asset class, and then we will continue to focus on strengthening our capital structure. And this is to be in line with our 2.0 growth strategy so that we can continue to harness the performance of our healthcare real estate property and to be able for us to enable to deliver a very stable and sustainable distribution to our unit holder over a longer period. Okay, over the next few slides, I will touch on our outlook and also just to reiterate on our 2.0 growth strategy. I will not go too much into the macro condition, just to say that if you look at Indonesia side, the inflation has actually eased to about 2.14% in August, the lowest since February 2022, and also on this front, I think they will probably be looking at cutting rate as well, on the Indonesia Central Bank, which means that they will also be looking at focusing on trying to stabilize the Indonesia rupiah before easing the rate in Q4 2024. They already cut rate once. I think they will continue to monitor the inflation and also looking at the currency movement before they talk about easing rate further. And if you look at Japan side, I think over the past 2 years, Japan has also been starting to enjoy a bit of inflation. Unlike in the past 2-3 decades, they have been in the deflation kind of mode. But the last 2 years, they have been seeing some inflation, and hence, Japan's has started to also hike interest rate. In fact, they were quite the opposite for the rest of the world. They are talking about hiding interest rate. Although the prospect of them hiding another or further interest rate still remain, but they will probably be also looking at some of the other indicator, including the prices, including wages, before they talk about whether to hike interest rate further. But having said that, for the Japanese loan, we have actually entered into hedges. In fact, it's on fixed rate basis. So if the Japan Bank of Japan were to hike interest rate, that would not have any impact on our Japan funding cost, because we have actually fixed or hedged the rate up to 2026. Okay, and then over at the Singapore side, the MAS will continue to maintain the rate of appreciation of the Sing dollar. In Singapore, MAS only use currency, to effect their monetary policy. Okay, and we certainly hope that they will moderate the rate of appreciation. Otherwise, with a stronger Sing dollar, that will have a greater impact on our foreign currency income. Okay, but nevertheless, we will continue to closely monitoring and also progressively hedge some of the net cash flow coming from Indonesia as well as Japan, in accordance with our hedging policy. Maybe just to touch a little bit on this net cash flow. Over the Japan side, we already has hedged 100% of our net cash flow that coming in from Japan all the way until December 2025. Over at the Indonesia side, we actually hedged about 50% of the income that's coming in from coming in from Indonesia. Okay, I'll move on to the industrial development. Sorry, can you move back to the previous slide? We'll go on to the industrial development. I think overall, healthcare real estate sector is very resilient, and so is a sector that will continue to perform, in the sense that if you look at the market that we have, be it Japan or Singapore, these are aging population. If you look at Japan, currently the number of people aged 65 and older has already hit a record high of about 36.2 million in 2024, and this figure will go up to close to 30%, within the next couple of years, and in Singapore we also have this problem. 12.4% of the population is above 65 years old. That was actually in 2014, and in 2024 now, close to 20% of the population is already 65 years and above, and come 2030, we are looking at maybe about 25%, 1 out of 4 of the population here will be age 65 here and above. And you can see that our government, the Ministry of Health, and also the Agency for Integrated Care has already started to look at more program, how we can cope with the rising of the healthcare population here in Singapore, as well as in even the Japan government is also implementing plan, how they can also cope with the staff care and also labor shortage, in society, as they see more and more people, more and more elderly population, coming on board. Over at Indonesia side, not exactly the aging population. In fact, the population of Indonesia, or rather Indonesia has a very young population, but as the people getting more and more affluent because of the good economy growth, more and more affluent people, more and more affluent middle income people, they will probably be looking looking to tap onto access more onto the healthcare need, in time to come. So all I want to say is that together with our strong support from our sponsor, we are well positioned to actually ride the tailwind in the healthcare real estate sector. And we will continue to focus on our 2.0 growth strategy. And if you look at our 2.0 growth strategy, is that we currently are looking at increase our portfolio in the developed market to more than 50% of our asset under management by FY 2027. So as of now, about 25% of our asset is already in the developed market. So we are looking at divesting or recycling capital from non-core as well as some of our mature asset, so that we can channel some of this proceed to developed market, so that we can actually reshape our portfolio for more capital efficient growth. So other than looking at diversifying into developed market, reshaping our portfolio, we also be looking at how we can also strengthen our capital structure so that we can remain resilient. We'll also be looking at diversifying our funding sources, not looking at just raising debt, borrowing from the bank. We also be looking at how we can issue bond, and also looking at other form of funding as well. And of course, last but not least, one of our pillar going forward as well is also to improve our ESG, so that we can continue to ride on the opportunity in our aging demography as well as the under-penetrated healthcare sector, especially in the developing country. Yeah. And finally, I just wanted to say in closing that, just want to summarize our 9 months business update as well as to highlight some of our investment merit. I think I shared earlier on that together with our strong sponsor, support from OUE Limited and also OUE Healthcare, we are well positioned to ride the tailwind in the healthcare real estate sector. And we also have a very sustainable rent escalation that's built into our master lease structure, thereby ensuring that we will have a balance of growth as well as stability. And our capital management remain very robust in the sense that we do not have any refinancing requirement until 2026. And we will also be focusing on developing our 2.0 growth strategy. And we want to target to grow our developed market portfolio, and thereby reducing our geographical as well as our tenant concentration risk. Okay, and above all, we will be able to provide unitholder with a very attractive distribution yield as well as sustainable distribution on a quarterly basis. Okay, and yeah, I think that's all I would like to share. Maybe I'll be happy to take some questions from here. Yeah.
Okay, thank you, Mr. Victor, for that insightful presentation on the latest updates from First REIT. We will now move on to the Q&A segment. So please feel free to submit your questions in the Zoom chat over here. For our audience on the Moomoo Live platform, you can click on the link to join us in the Zoom and post your questions on Zoom as well. We endeavor to answer as many questions as possible. So let's now proceed to the Q&A session. And there are some pre-submitted questions that we would like to ask Mr. Victor. I think the first question I would like to ask would be the 2.0 growth strategy, where we say the growth strategy usually means expansion. So you seek to diversify into developed markets and increase AUM by a massive 50% by 2027. So can you provide further comments on the First REIT progress on this and which particular markets we are looking at?
Yeah, sure. Okay, we actually derived this First REIT 2.0 growth strategy way back in 2022. Okay, so we actually give ourselves 5 years. We have this 5-year plan to diversify into different market, because in the past, you will see that Indonesia portfolio make up close to 95% of our total portfolio, and the remaining 5% is actually coming from Singapore. Okay, so and you know that 3 years ago, we experienced this restructuring of our master lease on the Indonesia front. Hence, we have actually come out with this 2.0 growth strategy, whereby we tell ourselves that we want to be able to diversify into different markets so that we can reduce some of these concentration risk, some of the market risk as well. Hence, in 2022, we acquire a portfolio of our nursing home, and this portfolio actually come from our sponsor, our parent company, OUE Healthcare. Okay, and immediately we are able to change our country in the sense that now as of now 25% of our portfolio is already in the developed market. Okay, and our target is that by 2027, okay, at least 50% of our portfolio will be in the developed market. And developed market at this moment we are looking at Singapore, Japan, and we also actively looking at another developed market, which I think I shared that a couple of times, and that's actually Australia. We have actually done some market study and looking at some asset also in Australia. So that will also be one of the market that we will be focusing on. So our target is that hopefully by within the next 2 years or so, we can actually have more asset in a developed country, and thereby reducing our risk profile as well. Okay.
Okay, thanks, Mr. Victor, for that answer. So one of the part of that question was the AUM to increase by 50%. I think, are we still on track for the AUM to grow by 50%?
Okay,
now?
We are not saying that the AUM will grow by 50%. We are saying that we want to reshape our portfolio in the sense that 50% of our AUM will be in developed market, not necessarily that it will increase by 50%. You see, if you look at our current AUM, is about 1.14 million. We are not looking at within the next 2-3 years, although we are not sure, because I think what is important for us now is actually, I think the first step for us is to reconfigure our portfolio to make sure that at least 50% of our asset base is actually in the developed market. Okay, and then we can look at growing our portfolio in time to come, as the interest rate environment start to come down, when the market is more conducive for the REIT to grow. Obviously, we would like to grow or we would like to increase our portfolio by 50%, at least 50% in time to come. Yeah.
Totally agree there. I'm also waiting patiently for the interest rate to come down, but it seems that the recent economic performance in the US especially says that the economy is still going strong. So that's why the pullback in some of the REITs recently in the past few weeks. So the questions that we have from the list is First REIT resilient financial position. As per what you shared earlier, there's no concern on the financial position of a First REIT, and the gearing is now below 40% already, and a big portion of the debts are on fixed rate or are already hedged at over 86%. So the Fed has already cut 50 basis points in October, and we foresee another 225 basis point cut this year. How is this going to impact First REIT?
Yeah, I think this is definitely going to be very positive for us in the sense that 86% of our debt is actually on the fixed or hedge basis. But out of this 86%, right, I would say close to 30% hedges will come off in December this year. Okay, so in December this year, 30% will not be hedged anymore. That means our fixed or hedge basis will come off from 86% to maybe about 50 plus or 60%. Okay, thereby will allow us to enjoy some saving in terms of finance costs going forward. Okay, but I think the saving will definitely come next year, probably not so much this year. Yeah.
Agree with that. So yeah, probably we are looking at more rate cuts next year. So we see that the hedging is going to come down to around 50% by 30% to end of the year. So that means that the First REIT would be able to enjoy or ride on the interest rate cuts going forward with the Fed rate cut that are expected to happen next year.
Yeah, absolutely. That's right. Yeah.
Thanks for that clarification. And then we also have another question. The First REIT financial performance is largely impacted by currency translation impact, as what you shared earlier. So can you elaborate more on the management of the currency risk and currency hedging on First REIT?
Okay, I think I briefly touched on the currency hedging policy early on during my presentation. If you look at the Japan side, right, which make up of about 22% of our portfolio in terms of asset value, but in terms of the rental contribution, is only about 15%. Okay, 15%. So the amount that will be flowing back from Japan, we actually have hedged 100% up to 2025. Okay, so as far as Japanese yen is concerned, we have managed to hedge, almost all the net inflow that's coming back to Singapore for distribution. But and then on the Indonesia side, we actually hedge about 50%. And the reason why we only hedge 50% is because if you look at the lease structure, which I also touched on during my presentation, is that for the Indonesia portfolio, we actually have an annual escalation of 4.5%. Or, I mean, if the hospital do well, we will get to enjoy the performance-based rent, which is 8% of the gross operating revenue of the hospital. So whichever is higher number, we will get a higher rental income. But at least we will have 4.5% annual escalation for each of the property. And this 4.5% annual escalation is supposed to mitigate some of these forex volatility. Yeah.
Okay, so that has been taken care of and looked into, and likely the risk of big currency movement will already have been managed by the policy that I put in place right now.
That at least is on the that at least is on the distribution side. Or of course on the balance sheet side.
Yes.
Yeah, I mean nobody will hedge the balance sheet because it's very, very expensive to have a balance sheet. And we still believe that I think the Indonesian economy didn't really perform that badly. We do not foresee that the Indonesian rupiah will suffer a very big depreciation. Hence and our gearing is only about 39%, which is still I mean there's still a margin of safety for us. So we do not foresee that we will be able to breach any of these MAS gearing limits. Yeah.
Understand. Totally agree that it's more of a concern of the strength of the Sing dollar, which has been persistently going very strong because of us MAS trying to contain the inflation situation here in Singapore.
That's right. Yes.
Yes. So we move to the live Q&A sessions. We see questions coming in. One of the questions by I think Mr. Lai Yong Chang, he says that it seems that Singapore rental income is doing better in terms of percentage than the Indonesian and Japan counterpart. So any issues or concern in expanding the nursing home acquisition in Singapore locally?
Yeah, obviously Singapore is always a key market, and and of course Singapore we do not have this currency volatility issue. Largely because of Sunny I think mentioned earlier on that MAS is only using currency to manage the inflation situation here. And because of that, I think the Sing dollar strength has always been very strong, compared to the rest of the currency in the region. In fact, Indonesia rupiah didn't perform that badly. I mean, if you compare Indonesia rupiah against some of the major currency, they actually did not too badly. It's just that Singapore dollar is just a bit too strong. That's why everything compared against Sing dollar, it's always a bit inferior. Having said that, Singapore has always been a key market for us, but it's always, because of the sector that we're in, healthcare sector, and there's not many assets that's actually available. This is the reason why we hasn't been able to acquire any asset in Singapore, but Singapore will continue to be one of our focus market, and we will always be on the lookout for suitable healthcare asset in Singapore.
Understand. Yes, so you also mentioned that Singapore is in an aging population kind of situation as well. So are there any talks with government agencies, or would there be any plans that Singapore nursing home will be increased? What kind of dialogue do you have with governments on the aging population growth?
Yes, I think Singapore, if you look at our demography, in time to come, 1 out of 4 people here will be 65 years above. So definitely will require a lot of nursing home, a lot of this healthcare facility. And I think they are projecting they probably need another 5,000 kind of nursing home beds, which will translate to maybe 20 or 20 plus kind of nursing home. So I think one of one of the method that the Singapore government or Ministry of Health trying to curb costs, especially is actually to build the nursing home on their own. Government will build the nursing home under this so-called BOL model, in the sense that when they will build the nursing home and they will find operator, the nursing home operator to tender, and then and then they will actually let the operator, private operator or other operator, basically nursing home operator, to operate the nursing home. Okay, and you know that being a REIT, we are not the operator. We are actually more of real estate, real estate, landlord kind of person. So we don't operate any of these nursing home. And as such, with this new government nursing home model, that will not benefit us, in the sense that we will not have the opportunity to kind of like tender or operate, because we are not in this business. And of course, government will also from time to time try to also tender out some of the land, so that we can bring in private operator, partner with some private developer, to develop nursing home and then to operate nursing home. We also did try to work with our sponsor, because we have two very supportive, strong sponsor, OUE and also OUE Healthcare, to be able to take on some of these development project. So at the right time, at the right price, we might be able to participate, together with our sponsor in some of these tendering of nursing home land project, but this opportunity doesn't come very often, and I'll say that government, I think going forward will want to build the nursing home themselves, and then they bring in the operator.
Understand, just like how our transport system is being managed right now in Singapore.
Absolutely.
It's by the government and managed by private operators.
Yeah.
Mr. Lai Yong Chang also have additional questions. He said that the end goal of the portfolio in terms of a portfolio allocation between Singapore, Indonesia, and Japan markets, at the end of the 2.0 growth strategy, what could be the composition, like the percentage of each country?
Yeah, I mean, the perfect ideal market, I hope we can have one third kind of structure. I think that would be beneficial. When I say one third, I'm also talking about maybe new country that we are also exploring, or maybe not one third, but we are also looking at bringing new country, which I shared earlier on, that we are also looking at the Australia market, So I would say that at least in time to come, more than 50% of our asset. In fact, I hope there will be a bigger number, maybe even to the extent of 2/3 will be in the developed market, and then maybe only 1/3 can be in the developing market.
So you do see that the nursing demand, healthcare nursing demand in Australia is actually growing as well. That's why we are looking at that as the first market of expansion into for First REIT.
Yeah, I think if you look at the three developed market that we are looking at, Japan, Singapore, and Australia. Australia is kind of new to us, but Australia actually have a lot of opportunity. In fact, interestingly, Australia, the government, healthcare is actually one of the major expenses, for Australia government, in the sense, and I think for Australia, I think they give us more opportunity, because over in Australia, right, the government actually will require a lot of support from the private sector. They actually work hand in hand with the private sector, so that the private sector can actually support the government in a lot of the healthcare spending. So one of the very interesting thing that we actually observe in Australia is that in Australia, the private hospital is always built next to a government public hospital, because there's a lot of synergy, within the same precinct, so the public hospital in Australia can always step on the expertise or the strength of the private hospital, to help them to provide the kind of support, for them to actually serve the population. So I would say that there are actually more opportunity, and then healthcare scene in Australia is a bit more mature, because they have a lot more subsector for instance, the life sciences sector is more mature as compared, to Singapore or some other country in the region. Yeah.
Hey, yes, I do agree. I do see some of these policies from the Australian government also addressing their aging population concerns and the retirement of the Australian citizens. Thanks for extending this Corporate Connect session with us today. We would just like to ask a final question from one of our viewers. His question was, the past few weeks has seen that the share price of REITs counter go up, with the exception of First REIT. Would you be able to explain or what the management would be trying to do to restore the First REIT share price, which has been stuck in the doldrums for some times?
Okay, I think I mean, if you look at our share price over the last year or so, right, I think just now Isaac also have highlighted, I think that was probably one of the best slides that I've seen, concerning our share price. I myself also didn't realize that our share price actually performed that well. Okay, for year to date, I think our share price, the total return, for First REIT share is approximately about 15%, 14.9%, which is quite good. Compared to, FTSE REIT index, the total return is only 3.8%. Of course, this 14.9% actually includes the dividend that we have actually given out as well. So I would say, if you hold our share price in the beginning of the year, I don't think you perform that badly. But again, share price is not something that we can manage. We will continue to, like I said earlier, we will continue to focus on executing our 2.0 growth strategy. And once we are able to do that, we are able to reshape our portfolio. We're able to, readjust our risk profile. Hopefully, share price will adjust accordingly as well.
Hey, definitely, I agree with you. The performance of First REIT share price or unit price this year has been very decent actually. From the low of, I believe, last year we are looking at 21.5 cents, 22 cents. We are now at about 27 cents already. So it's actually on an uptrend on a longer term. And just now, our good friend Isaac shared with us, if we look at a 2 or 3 year term, definitely the returns is also quite attractive as well for First REIT. So I'd like to thank Mr. Victor for taking time to share with us these updates and his opinions on First REIT as well as the REIT market as a whole. We hope that everyone today found this Corporate Connect session informative and useful. If you do have any other questions, do feel free to contact the investors relation of the company First REIT. And if you miss any of today's session, you can actually rewatch this webinar on SIAS Facebook channel and YouTube channel as well. So Corporate Connect is our bi-weekly webinar. So do visit our SIAS website to get more updates for our upcoming investors education program and initiative. Our next Corporate Connect session will be on the 26th of November, featuring Fui Corporation. You may also type in the chat box to let us know which listed company you would like us to feature next. And thank you for joining us this afternoon. Take care and have a good week ahead. Thank you, Mr. Victor.
Okay, thanks, Sunny. Thanks for having us.
Thank you.
Thank you so much.